Next on stage, driving value through liquidity centralization, the power of cash pooling and payments on behalf of. Joining us are three partners at EY, Elina Chronopoulou, International Tax and Transfer Pricing, Kostas Stathopoulos, Finance Consulting Leader, and Kostis Chlouverakis, Technology Consulting. Please welcome them to the stage.
So good afternoon again. We will discuss about liquidity centralization. Technical issues might happen there as well and will be much more difficult to resolve than the one that we did right now, Elina, for sure. And we hope that that doesn't happen for liquidity matters. All treasurers know that. So in an environment of rising interest rates, volatile markets, and heightened regulatory scrutiny, we all know that managing cash effectively, it's not just about efficiency, but it's also about the resilience of our businesses and the value creation for treasurers to create for their businesses. Cash poolings and payments on behalf of, or POBO, are two of the most powerful tools that treasurers can use to centralize liquidity. And those are two tools that can help a lot in order to help on the transformation of treasury into a really strategic driver of value for businesses. But of course, as everything in life, the benefits don't come without challenges. So there are always tax and legal implications that can make these structures difficult to implement, and regulators are there always increasing what we need to deliver and be careful of. On the other hand, operationally, the organizations face hurdles in technology, in governance, in change management, reorganizations, and all the internal transformations. And with the rise of AI, treasurers now need to consider how technology can help them manage both the opportunities and the risks. In order to explore all of these dimensions, we are very happy to have today three experts from EY. I'll start with a lady. Elina, it's our tax expert for this session. So she's going to help us on understanding all the regulatory tax and compliance challenges of cash pooling. Kostas, who will be the first that will open the discussion on explaining what cash pooling and POBO is, and will bring all the corporate treasury and the strategic perspective. And Kostis is the one that it's going to explain us how we can make our life much easier and how all the digital tools and artificial intelligence are reshaping the way we centralize liquidity. So, Costa, let's start with you. What is cash pooling and POBO?
Okay, thank you very much, Andiola, and thank you all for having us here. It's great to be here for the fifth time in a row, and it's amazing to see how much the Hellenic Association of Treasurers have managed to grow this event, and it's really great to be here, like every year. So let's start with some definitions. So cash pooling is a financial management technique that allows companies to optimize the liquidity by consolidating cash balances across different accounts. There are two primary, so to say, cash pooling methods. So it's physical pooling. It's shipping the funds into a central account. So this relates to actual transfer of money, so it might incur some additional cost, transaction costs, etc. And the notional pooling, different approach. So the balances are offset in a virtual manner rather than having actual funds transfer. So there's no physical movement of funds, but it can be more challenging in terms of regulatory requirements and monitoring, etc. So the payments on behalf of, in essence, a central entity executes payments on behalf of their subsidiaries. It's a centralized payment method that allows banks to do execution on behalf of their other entities, and in this manner, again, it's a measure of optimizing, the use of cash and the overall process of the treasury. Again, all those come with several other things that need to be considered.
So, Kostas, what what drives the companies to adopt these strategies, and what is the real value that they see in practice?
Okay, there are several reasons that that a company would want to go through a strategy like that. First of all, the need for improved liquidity management. Companies want to optimize their cash positions to avoid having bad forecasts, to enable better forecasting of the cash balances, to avoid having trapped cash, and to be able to have the appropriate funding to fund their operation. So optimization of cash utilization is key. This also comes with something more tangible like cost savings, so reducing the need to borrow money and utilizing your cash, but also it can have some benefit in terms of interest income, so not leaving cash unutilized, but being able to safely centrally invest it for the periods that it can be free. Another thing that I think for all treasurers and finance departments is of utmost importance relates to the overall, the better control and the enhanced oversight that a company would have for evaluating where the cash is, to avoid issues of fraud, of errors, etc., and also to comply with all the regulatory requirements that, especially in the digital payments era, become a lot more difficult, and a lot of scrutiny is in place. All in all, this leads, I would say, to the need for increased operational efficiency. I mean, reducing the complexity of the structures is a key thing. So before starting some of this journey, some reduction of the complexity would be a good thing to do. But also reducing the number of accounts, reducing the reconciliation points, automating all those things. So the operational efficiency element is really a key driver to this project.
Great. Thank you, Costa. And on the considerations that...
Sure. We said about the benefits that exist. So we talked about reduced external borrowing, with simplification of bank accounts, enhanced cash visibility, governance, flexibility and scalability, which is important for large groups that embed new companies every now and then, but everything comes at a cost. So the considerations around this is that it is a complex process. It requires some kind of investment. There is a lot of regulatory issues and different regulatory requirements in different jurisdictions that need to be monitored. So apart from the financial element, you need to have some kind of very good regulatory and tax planning way ahead in order to see whether this is a feasible situation for each entity, or if it's worth doing it, including, of course, transfer pricing. Elina will discuss about this, so how you determine the documentation that the companies need to have between subsidiaries to enable all those transfers of funds and the transactions between the companies. Another thing, and I think that's why we cover all these areas, Kostis, in the next questions, IT integration. So I heard the previous panel also discussing about the importance of IT integration between systems. And of course, in order to be able to go through that, is you need to invest in systems. You may need to see the integration points with ERP, how powerful the ERP is, if you can support the global view of all the accounts, and what you need to do in order to achieve that. And having said that, I think all those end up to change management of the organization. So going through some different process in the way that you handle cash at the global level will definitely require some change management procedures, because people are not going to be doing the same kind of work. There are going to be different processes, systems, etc., which is also an enabler, because you let people do more strategic stuff, you eliminate reconciliations, manual work, errors, etc. But on the other hand, changes, we all know how difficult changes are within the organization, and that's, they are on their own a different project that has to be assessed.
Thank you, Kostas. Really very important highlights, and it's also the challenges and the implications that you mentioned that are important, because no matter how compelling a business case may be, treasurers cannot ignore the legal and the tax implications. So let's turn to Elina to understand the key risks and the safeguards the companies must consider when implementing these two strategies.
Well, Kostas already mentioned a lot of benefits from cash pooling structures, but to maximize those benefits, you need also to take into account regulatory and tax aspects from the very beginning. Not only to be aware of compliance obligations that will come after a rollout, but also to for feasibility assessment, for identifying opportunities to mitigate risk in advance, and also to select the most suitable structure. So to start with, especially when we talk about cash pools that have a global scale, one of the things is the regulatory framework, that it's different between countries. And we've seen regions like part of LATAM or Asia or some African countries that there may be barriers of forex controls or restrictions in the movement of capital that can make implementation impossible or, to the least, very challenging. Okay, so that's one thing. Now, moving on to the tax perspective, well, depending on the nature of the cash pool, whether it's a physical cash pool, whether it's a notional cash pool, and the specifics of the structure, there may be different aspects to consider, but certain aspects are generally relevant to all situations. First of all, cross-border interest payments may trigger withholding taxes. Liability may be reduced or eliminated depending on double tax treaties, EU directives, local provisions, but it is quite important, especially in cases of physical cash poolings, to assess proactively, because assessment may be needed also before selecting the location of the cash pool leader. And another issue with withholding tax is to evaluate whether it is feasible, this withholding tax, to be set off against corporate income tax, in which case it's just a timing difference, or if it will end up, it's expected to be a cost for the group. Another issue is intra-deductibility limitations and think-up rules. Generally, interest expense is deductible. However, in most countries, they have specific rules on how much interest you can deduct for tax purposes, and think-up rules that directly link to the intercompany interest payments. So that's another issue. And of course, other tax liabilities like stamp duties or other levies that may be particularly relevant in some countries and can significantly increase the cost for the group. Here in Greece, we have our own digital transaction duty to consider, right? And last, I saved it for last, because of the intercompany nature of the cash pooling structures, it's transfer pricing considerations, right?
So I understand that transfer pricing can play an important role from the initial design of the cash pooling, and it should be considered. How exactly does it play out in practice?
Well, the core principle of transfer pricing is that all arrangements are priced at arm's length, which in essence means that the terms are agreed in the same manner as independent parties would do. The TP analysis for cash pools generally addresses two aspects. One has to do with rewarding the cash pool leader based on the activities it performs and the risk it assumes, and the other is setting the interest rates for the debit and credit balances of the participants, taking also into account potential synergies and benefits that need to be also allocated to the participants, and the options realistically available to the participants. So this can be a quite challenging process, taking into consideration that the purpose of a cash pool is not to create profit as opposed to a bank. It's to make use of cost savings because of synergies. There are no comparable transactions in the open market. And there may be interdependencies and interrelations between the participants of the cash pool, for example, cross guarantees, that need to be further assessed and evaluated in the context. One thing that I think it's important to note is that from experience, it's quite common TP considerations to be considered on a later stage after implementation for purposes of compliance and with obligations, but transfer pricing alignment is not a formalistic one-size-fits-all situation. So it's very much dependent on the actual facts and circumstances of the case, and it goes beyond a mere analysis of interest rate. It also addresses other structural aspects of the transaction that can have an impact on the pricing, but can also create other tax consequences. For example, structural aspects that have to do with the financial capacity of the cash pool leader. So contractual assumption of risk is not sufficient. If the cash pool leader is rewarded for a contractual assumed risk, then it also needs to have the financial capacity to assume the risk, which means practically having the people with the decision-making authority to control and monitor the risk, and also the resources to assume the impact, the financial impact, in case this risk materializes. Another issue is the debt capacity of the participants. If cash pool borrowers are leveraged outside market norms, the borrowing can be viewed as equity and therefore limit interest deduction, or issues relating to alignment of the actual practice with the nature of the cash pool itself. Cash pooling is, in practice, a short-term liquidity management tool. So it implies that you have short-term, both-sided transactions. If this is not the case, then you have the risk to reclassify those transactions into longer ones, which can have impact on pricing, but it can also trigger other tax considerations, for example, stamp duty, if it's considered to be a loan. So to avoid this kind of pitfalls and complications under the, in the process, I think it's quite important to keep in mind to involve the TP team right from the start, and ideally at the time of design, where business and operational structure is still determined and aspects are still finalized.
Thank you, Elina. So we have talked a lot about the need of tax and transfer pricing considerations to be accounted for right from the beginning of the design of a cash pooling, but does it end there?
Well, I think the short answer is no. To make the most of the benefits in the long run, and to make sure that you avoid unexpected tax liabilities that can have an impact on the overall efficiency of the structure, ongoing compliance is also very important and should not be overlooked. And this comes with complexities of its own. So imagine you have many countries, different tax aspects, different deadlines to consider. Laws are changing, but not only that, you have market conditions and business needs that are evolving. So in order to ensure that you have a sustainable and effective structure for the longer period, you need to stay ahead of regulatory changes and also be able to adapt swiftly to new requirements, regardless whether this has to do with regulatory requirements, business requirements, or even both. A good governance model with complete and well-documented policies and procedures that are frequently revisited and updated can be a good starting point to mitigate monitoring risk and streamline somehow this compliance need and swift adaptability.
Thank you, Elina. So we heard how regulation and tax shape what's possible, but technology, and in particular AI, is now reshaping how treasurers can operate within those boundaries. Kostis, where does AI fit into the liquidity centralization, and how is it changing the game? How does AI enhance liquidity centralization strategies?
Yeah, sorry. So AI can enhance this liquidity centralization in three tangible ways. Sorry, I need.
No.
It's fine. So now, yeah. So the first thing that comes to mind is forecasting. So AI, we know, and this across industries, it can offer far more superior models in forecasting of liquidity compared to all the manual efforts. And we have seen this happening and regarding accuracy results, especially for short and long-term predictions. Secondly is real-time analytics. So what we have seen is that AI can offer a single group-wide view and overview of the liquidity that within an organization, and this is the heart and backbone of centralization, from what we know. Third is scenario modeling. Imagine how important it is to have AI to be able to test the impact of pooling and also POBO structure and outcomes before implementation, and therefore the decisions are based really on data rather on guesswork and very manual intuition of people. And then we move to the fourth one, which is optimization, that AI can recommend the best practices, and this is again the backbone of analytics. Up to now, and many years ago, we were discussing about descriptive analytics. So here are my data, and this is what I can do. Then we move to predictive analytics, which is exactly what's going to happen. So with forecast, we say that, yes, and it's very accurate with AI, that's going to go from 5 to 7, for example. But what AI can offer is the prescriptive analytics, as we call it, is why this happened, so why I'm going to have an increase or a decrease, and the most important thing is what can I do with that. So, for example, it can offer the best use advice about the best use of liquidity, for example, about how to repay debt, how to invest, how to move to internal lending, and so on. So AI is not a panacea, right? And we will see it later. There's a lot of discussion about AI across industries, but in this specific topic, it's very important to understand its applications and how it can augment and enhance these liquidity centralization strategies.
And Kostis, can AI help the businesses also to reduce manual effort and cost?
Yeah, that's the number one also application, let's say, of AI, again, across industries. I understand that in this specific topic, cost reduction is the number one, and absolutely the answer is yes, but we see it also in other industries as well, that it's more about cost reduction rather than revenue generation, and it's something that we see also clients keep asking for that. First of all is smart reconciliation, so we have so you can match automatically intercompany flows. Secondly, it's very, very important to understand how it happens to have the payment compliance screening. So, for example, how you can automate AML and sanctions checks. Third one is it has to do with process automation. So, with AI, you can have this process automation, and this means by far fewer touch points. And when you have fewer touch points, it means that at the end, you're going to have fewer man hours. So you have an FTE, full-time employee, cost reduction, which is one of the C-level always discussions. And this is the direct cost that is being saved. But the most important thing is that you can have an indirect cost saving, which is by reducing payment errors. So by reducing the risk of having errors in payments, it gives a lot of money at the end, so you save a lot of money. And also something that people don't think of, and it's going to happen much more intensively in the future, is that you're going to have, companies are going to have much less reliance on consultants. That's a not good thing for us, but it's going to happen. And also with partnerships that companies do for financial modeling and so on. So it's what we say always, that the AI can automate and can give better results, but at the end, you will be able to move your people and move your staff to more judgment roles, as we call them, more strategic roles, rather than doing data entry and manual efforts.
Thank you, Kostis. Really interesting. And what's in your opinion the most impactful applications of AI today in Treasury?
The most mature one is the one that we discussed. It's the liquidity forecasting. It's already deployed in many treasuries, and again, that's the most mature across industries forecasting. Right? It's a very, very old exercise and problem, and it's as good as your data. So that's the number one thing that we always mention. Then it's fraud and anomaly detection. It's something that we always see again in other industries, and it's very nice to see this alignment. With AI, you can do this in real time, so you can detect anomalies like unusual patterns. You can detect and flag specific payments. So that's the second one, and these two are the most mature ones. Then we have the regulatory compliance monitoring that's very applicable in very complex jurisdictions. So it ensures that adherence to local restrictions. And then it's the decision support. Again, that goes to my prescriptive analytics discussion that I did before, that AI can equip treasurers with playing with data-driven scenarios and offer these insights and the best and worst case scenarios with all the outcomes to your CFOs and to your board members. So the first two are very mature. The other two, the regulatory compliance monitoring and the scenario modeling with the decision support, are nascent exercises, but they are rapidly accelerating now.
Thank you, Kostis. So we have seen the business benefits, the legal constraints, and the technology enables, but as we can understand, all of these perspectives don't live in isolation, but they intersect every day in the real world. So let's make a little bit more difficult questions to our panel. So, Kostas, you highlighted the efficiency and the cost savings, but how do you balance these goals with when Elina on her end, she pointed out compliance and regulatory risks and how those can impact the cash pooling or POBO?
Yeah, that's very interesting. I think it captures exactly the nature of what we're discussing. I think as we have discussed, this is a multi-dimensional project. I mean, when an entity wants to invest in this financial management technique, it has to capture several elements, several layers that need to be addressed. So, in one word, it requires some investment. We're all finance people here, and so you need to be able to calculate the return on that investment. That could relate to the complexity of the group structure, as we discussed before, how easy it would be to fix this, to remediate it. What would be the benefit of doing that? What are the number of people working around the group relating to this type of tasks, and what are the synergies and the efficiencies that will occur upon implementation? What are the reporting systems we currently have, and what level of investment? And this could be quite expensive. And it needs to be aligned with the overall strategic view and vision of the company and relate to the overall IT architecture or IT strategy of the company. It's not something that we can decide today and do tomorrow. It's something that has to be built on. So all those elements is like doing a cost-benefit analysis that would end up to some result, whether the return on investment is something significant that we want to go ahead with. But it's not only the monetary element that we've been discussing, because apart from the figures and all, it's also about governance, having accurate forecasting, optimizing our business, having our people happier. It's also very important, and I think we tend to see it as consultants very, very often now these days that we get projects because companies want to have people happier rather than just optimizing, things, because you cannot really retain talented professionals, having them reconciling figures, all day long, and then reviewing their own things, etc. So, therefore, there is an intangible part in all this that has to be included in the overall return on investment, let's say, calculation. But it's definitely a multidimensional thing that has to be addressed in all its constituents.
Very interesting, Costa. Elina, what would be your point of view on this?
Well, I agree with Kostas, and acknowledging that tax can put constraints on the whole structure. I think there are inherent trade-offs between maximizing efficiency and all the benefits that Kostas mentions and being compliant. But the actual challenge here and what should be the goal of all teams involved is how to strike the right balance. So with that in mind, I think it's very important for all teams and stakeholders, legal, treasury, tax, finance, to collaborate and be involved in the process from the early beginning, but also moving on.
And Elina, I'll continue with you. I'll make my next question to you. Could AI tools realistically reduce some of the compliance risks that you have discussed?
Well, absolutely, at least from experience so far. Tax compliance can be a particular challenge, but the good thing about tax is that it's very rules-based and data-driven, and this makes it an ideal candidate for standardization and automation. So there are many aspects of the compliance process that can benefit from AI solutions. It could do with automating manual, repetitive processes, which, by the way, based on a recent tax survey, takes up more than 65% of the tax function. I mean, it's amazing. Enhancing risk and audit trail monitoring for audits or providing insights to better decision-making. But I would assume that Kostis also has something to chip in this.
No, I would agree. No, I would agree with Elina. But the risks are real, but AI can play, let's say, a defense, like a second line in defense, right? We saw that all the things about forecasting, about the email, about fraud detection, and that it can keep a very clean audit trail. But on the other hand, it doesn't remove the obligations, and what it can actually do is to make compliance faster and more reliable across the organization on a wider scale. So yeah, the answer is yes, but it has to be in the back and to cover for the people and try to automate whenever it can.
So, Kostis, do you believe that AI is mature enough to give to the treasurers and to the senior management of the companies, to their boards, the confidence that they need to pursue centralization?
Yes, yes. This is not an absolute answer, though. I mean, my feeling here, and I thought of that a lot, is that we saw again that we have the forecasting, we have all the AML, the fraud detection again, but confidence does not come alone. In order to have AI bring the confidence, you need also explainability and traceability. So these are the two things that people will always be asking. So think of AI as giving an augmented confidence to treasurers. So it's not, again, a panacea that it's a black box. And this is what people usually misinterpret when they say, I want to do AI. And we have very often clients coming to us and saying, I want to do AI. What should I do? In the specific case here, it applies again 100%. So what you need to do is to take advantage of all these nice things that AI can do. It can give you this augmented confidence, and it can give you also at the end all these strategies that we discussed with all these nice insights and cost reduction and all these nice things. But at the end, it's up to the treasurers to take advantage of that and make the best out of it.
Costa, would you like to add something on what Kostis mentioned?
The question is spot on, and I think the way we are structured here, for example, and as a firm, and how we approach projects with clients relates to the different dimensions that these types of projects have. So AI on its own, maybe there is different level of understanding between people and between functions within the firm, what it is about, how it can help. And it's not like a robotic process automation or the technology that we used to have. It's like that can really provide more insightful information, decision-making information for the leadership of the companies. So I think it should be placed in a way that it is captured on a company-wide level. That's why, Kostis is a technology person, I'm a business person, Elina is a tax person. So, and that's why I mentioned before that it has to be somehow aligned with the overall strategy of the group. You cannot just have bits and pieces of a little bit of AI here, a little bit of AI there. This has to be aligned, and what is the purpose of using the technology? Using technologies that can talk to each other in a seamless manner across the functions of an entity, the operations, the sales, how the figures derive, and so the treasury being the heart, let's say, of the operation, and in terms of cash and the outside world, the banking world, etc. What comes there has to be some part of an overall strategy and what we want to achieve. So the answer is yes, I definitely agree. It can give a lot of solutions, but has to be used in a strategic manner, with the proper design and the people that have the understanding to be able to connect the dots between the firm.
And Kostas, I think you did the perfect summary of our discussion, so I don't need to do like a closing note of our panel, because you mentioned everything, like how powerful these two tools can be, but treasurers should be, and the companies should be very careful on all the implications, and AI is here to help us, but Kostis explained that very well, that we should be careful on that one as well, because the person, our people who are analyzing the data and know the business should be there to add that value. Thank you very much. Thank you very much for this very, very good session, and thank you for attending us. Thank you.